Every trader says they understand risk. Almost none of them behave like it. They speak the language of discipline while trading like gamblers. They talk about protection, while secretly hoping the next position will rescue their mistakes. They believe risk management is a tool for later, after they become profitable, after they feel confident, after they figure it out. But risk is not something you add to trading. Risk is trading. Everything else is decoration. Charts are decoration. Indicators are decoration. News is decoration. The only permanent structure in this profession is the relationship between exposure and survival. You are not paid for intelligence. You are paid for durability, and durability is built on rules that feel restrictive, uncomfortable, and painfully slow. Most traders reject those rules. They want freedom. They want speed. They want the emotional rush of big positions and dramatic recoveries. They want to feel powerful in the moment, even if that moment costs them months of work. They believe control will arrive later, after success. Control never arrives later. It must exist before success, or success will not stay. The market is not hunting you. It is not targeting your stops. It is not conspiring against your account. The market is neutral. It simply exposes the parts of your character you refuse to discipline. If you are reckless, it magnifies recklessness. If you are impatient, it punishes impatience. If you are arrogant, it waits until arrogance grows large enough to collapse under its own weight. Risk rules are not about the market. They are about containing the worst parts of yourself. They are fences built to protect you from emotional cliffs. They exist because your instincts under pressure are unreliable. The brain that chases after a loss is not thinking, it is reacting, and reaction is the enemy of survival. The trader who lasts is not the one who predicts best. It is the one who refuses to self-destruct. That refusal is not dramatic. It is quiet, repetitive, sometimes humiliating. It means cutting trades early, trading smaller than you want, walking away when you crave revenge, accepting that slow growth is the only growth that survives. The rules feel like chains at first. Later you realize they are armor. And without armor, no trader survives long enough to learn anything. Risk management is not a chapter in trading. It is the spine. Remove the spine and everything collapses, no matter how strong the limbs appear. Most traders decorate their craft while ignoring the structure that holds it upright. They obsess over entry precision and ignore exit discipline. They chase perfect setups while their exposure runs wild. They want to look skilled before they learn how to stay alive, and the market punishes vanity. The first rule of survival is simple. Never risk enough to emotionally care about a single trade. The moment a position becomes personal, you are compromised. Your judgment bends toward hope. You stop evaluating information and start defending a belief. The trade is no longer a business decision. It is an emotional commitment, and emotional commitments are expensive. Small risk protects clarity. Large risk invites distortion. Most traders secretly want distortion. They want the adrenaline of meaningful stakes. They want to feel the pulse of danger because it convinces them they are doing something important. But importance in trading is not measured by intensity. It is measured by consistency. Consistency requires boring position sizes. Sizes that do not excite you. Sizes that do not scare you. If a single trade can change your mood dramatically, it is too large. The market should not have that level of access to your nervous system. A professional trader protects emotional stability as aggressively as financial capital. The two are inseparable. The second rule is acceptance. Every trade must be entered with the full acceptance of loss. Not theoretical acceptance, not optimistic acceptance, real acceptance. You must feel the possibility of loss and remain willing to proceed. If you hesitate because the loss feels unbearable, the size is wrong, or the setup is misunderstood. When you enter a trade trying to avoid pain, you will manage it poorly. You will delay exits. You will negotiate with reality. Reality does not negotiate back. A loss avoided emotionally becomes a larger loss financially. This transformation is predictable. It happens because fear stretches time. Seconds feel like opportunities for rescue. You wait for a bounce that never comes. You widen risk because admitting error feels worse than bleeding slowly. Bleeding slowly is how accounts die. Quick losses heal. Lingering losses infect. The disciplined trader cuts infection immediately. There is no drama, no internal speech, no promise to wait just a little longer. The exit exists before the entry. Once triggered, it is executed. The trader does not vote on it. They obey it. Obedience to your own rules is the foundation of authority. If you cannot command yourself, the market will command you. The third rule is position humility. No single idea deserves respect until it proves itself. Most traders fall in love with analysis. They believe conviction should be rewarded with size. They scale up based on emotion instead of evidence. They treat confidence as a signal. Confidence is often ignorance wearing a uniform. The more certain you feel, the more cautious you should become. Certainty narrows perception. You stop seeing opposing information. You interpret noise as confirmation. The trade becomes a narrative instead of a probability. Probability demands humility. You start small. You add only if the market confirms your direction. You let price validate you instead of declaring victory early. Adding to losers is ego. Adding to winners is structure. One expands emotional exposure. The other compounds strength. Most traders reverse this instinct. They defend losers and doubt winners. They average down to avoid embarrassment. They take profits early to protect relief. This is psychological inversion. It feels safe but guarantees decay. The professional does the opposite. They tolerate discomfort when right and refuse comfort when wrong. The fourth rule is time discipline. You cannot force the market to move on your schedule. Yet traders act as if impatience can accelerate opportunity. They overtrade during slow periods. They manufacture signals out of boredom. They treat inactivity as failure. Inactivity is protection. The hardest position to hold is cash. It feels like surrender. It feels like missed potential. But cash is a decision. It is a statement that conditions are not aligned. The trader who cannot sit out is already enslaved to motion. Motion is seductive. It creates the illusion of productivity. But productivity in trading is measured by selective participation. You are paid for waiting correctly. Most traders wait incorrectly. They stare at the screen until fatigue erodes standards. Then they take marginal trades simply to end the tension of watching. That is emotional relief trading. Relief is not an edge. Time discipline means walking away when conditions are poor. It means ending the session when clarity fades. It means accepting that opportunity is not constant, and pretending otherwise is self-deception. The fifth rule is draw down respect. A losing streak is not an invitation to attack. It is a warning to reduce exposure. Most traders respond to pain with aggression. They increase size to recover faster. They believe intensity can erase damage. This belief is emotional mathematics. It ignores probability and worships urgency. Urgency destroys structure. After losses, the mind is unstable. Perception is tinted by frustration. Decision quality drops. This is the worst moment to escalate risk. The professional shrinks, smaller positions, fewer trades, slower decisions. Recovery begins with restraint. You stabilize before you rebuild. The amateur rebuilds while collapsing. That is why their cycles repeat. The sixth rule is separation of identity. You are not your last trade. If you merge identity with outcome, volatility enters your personality. You rise ND fall with every tick. Confidence becomes fragile. Fear becomes constant. The market gains access to your self-worth. That access must be denied. Trading results are feedback, not verdicts. A loss does not make you weak. A win does not make you strong. Only behavior measures strength. Did you follow rules? Did you manage exposure? Did you exit correctly? If yes, you succeeded regardless of profit. This separation allows emotional neutrality. Neutral traders see clearly. Attached traders hallucinate patterns that justify their feelings. The market becomes a mirror for insecurity instead of a field of probabilities. The seventh rule is capital preservation obsession. Growth is optional. Survival is mandatory. You cannot compound what you do not protect. Every great account is built on long periods of uneventful preservation, boring months where nothing dramatic happens. Most traders cannot tolerate boring months. They sabotage them with unnecessary risk. They crave acceleration. Acceleration shortens careers. Slow growth lengthens them. The trader who lasts decades is not spectacular daily. They are stable daily. They treat capital like oxygen, invisible until threatened. Then suddenly everything depends on it. A reckless trader notices risk only after suffocation begins. By then it is late. The eighth rule is emotional audit. You must monitor your state before every trade. Fatigue, anger, excitement, desperation. These are risk variables. Ignoring them is like ignoring market conditions. You're part of the environment. Your mind is the instrument, executing decisions. A damaged instrument produces distorted output. If you feel unstable, you trade small. Are or not at all. This is not weakness. It is calibration. Pilots do not fly impaired. Surgeons do not operate shaking. Traders should not expose capital when emotionally compromised. Yet most do. They believe discipline will appear mid-trade. It rarely does. Preparation determines performance. The ninth rule is profit restraint. Big wins are dangerous. They inflate ego and distort future risk tolerance. After a large gain, traders feel invincible. They loosen standards. They increase size. They assume momentum will continue. This emotional expansion is the twin of revenge trading. Both end the same way. The professional responds to large wins by tightening. They protect the gain psychologically. They return to base size. They treat the win as an anomaly, not a new identity. The goal is stability, not emotional elevation. Elevation invites collapse. The 10th rule is rule permanence. You do not change risk rules during emotional peaks. Rules are written in calm and enforced in chaos. If you rewrite them mid-storm, they are not rules. They are excuses shaped by fear or greed. Permanent rules create a fixed boundary. Inside that boundary, freedom exists. Outside it, destruction waits. Most traders redraw boundaries daily. That is why their equity curves look like heart monitors. The 11th rule is accountability without mercy. You must review mistakes brutally, not to punish yourself, to remove illusion. Soft reviews preserve ego and repeat errors. Hard reviews expose patterns, overtrading after losses, oversizing after wins, entering out of boredom. These patterns are visible only to traders willing to look without defense. Defense protects pride. It destroys accounts. The 12th rule is patience with growth. Skill compounds slower than desire. You will feel ready before you are ready. You will crave size before your process can carry it. Resisting that craving is maturity. The market is not impressed by ambition. It rewards readiness. Readiness is proven by repetition, thousands of disciplined executions, not weeks of excitement. Most traders want the reward without the years required to stabilize behavior, so they rush. And rushing exposes them to the one force that ends careers permanently. Uncontrolled risk. Risk is not dramatic when managed. It is invisible. The public imagines trading as constant action. The reality is long stretches of quiet interrupted by precise decisions. Inside that quiet, discipline is built. Each day you refuse unnecessary exposure. You strengthen the architecture that will hold larger size later. Architecture first, expansion second. Reverse the order and collapse is guaranteed. The market is not your enemy. It is a measuring device. It measures your patience, your humility, your honesty. Every trade asks the same question. Will you protect yourself, or will you chase relief? Most choose relief. Relief feels good briefly. Protection feels uncomfortable immediately, but preserves future opportunity. Future opportunity is everything. A trader who survives long enough can adapt, learn, refine. A trader who explodes resets to zero. Repeated resets create the illusion of effort without progress. Years pass, behavior stays the same. The market remains consistent. Only the trader refuses to evolve. Evolution requires surrender. You must surrender the fantasy of fast success. Surrender the image of heroic trades. Surrender the addiction to action. In its place, build a professional identity grounded in restraint. Restraint is power, quiet, durable power. It does not announce itself. It does not need validation. It executes rules regardless of mood. It protects capital regardless of temptation. It waits without complaint and acts without hesitation. That is the mind that survives here, not the loud one, not the desperate one, the controlled one. Every risk rule exists to build that control, not to limit you, to preserve you. The trader who understands this stops fighting structure. They lean into it. They accept that freedom in trading comes from restriction, not indulgence. Restriction sharpens judgment. Indulgence dulls it. The market rewards sharp minds, and sharp minds are built through disciplined risk, repeated daily, long after excitement fades, and only professionalism remains.